Welcome to the elite world of advanced estate planning in 2026, where the financial landscape has undergone a monumental shift thanks to recent legislation for high net worth individuals. The conversation has moved beyond the fear of a tax sunset and into the reality of a permanent $15 million federal exemption. This massive threshold provided by the One Big Beautiful Bill Act means that a married couple can now shield $30 million from the federal government without paying a single cent in estate taxes. However, for those whose fortunes exceed these generous limits, the stakes remain incredibly high, because every dollar over that line is subject to a 40% federal death tax. Today, we are breaking down the most sophisticated strategies used by the world's wealthiest families to freeze asset values and transfer multi-generational wealth while keeping the Internal Revenue Service at bay. If your estate is currently valued at $20 million or your family office is managing over $15 million, the next 10 minutes will define how much of your legacy remains in your hands and how much goes to the Treasury. To understand the urgency of 2026, you must first recognize that while the exemption is higher than ever, the appetite for tax revenue has not diminished. The federal estate tax remains one of the most aggressive tools for wealth redistribution, and the 40% rate can effectively liquidate a family business or a real estate empire in a single generation if you are not prepared. The first and most fundamental strategy in our toolkit is the aggressive use of the $15 million lifetime gift tax exemption. In 2026, the philosophy is no longer about waiting until death to pass on assets, but about moving them now to lock in their current value. By gifting assets today, you are not just removing $15 million from your taxable estate, but you are also removing all future appreciation on those assets. If you give $15 million worth of high-growth tech stock today, and it triples in value over the next decade, you have effectively moved $45 million out of your estate while only using $15 million of your exemption. This is the power of early gifting, and it is the foundation of every successful high net worth plan. The second pillar of 2026 planning is the intentionally defective grantor trust, commonly known as the IT. This is a masterpiece of legal engineering that allows you to separate income tax rules from estate tax rules. When you transfer assets into an IT, you are effectively removing them from your estate for death tax purposes, but you remain responsible for paying the income taxes generated by those assets. While this might sound like a disadvantage, it is actually a massive hidden gift to your heirs. By paying the income taxes yourself, you are allowing the trust assets to grow at a gross rate without being depleted by annual tax bills, while simultaneously reducing your own taxable estate by the amount of the tax payments. In 2026, the IT is frequently used to house family business interests or commercial real estate because it allows for a value freeze where you sell the asset to the trust in exchange for a low-interest promissory note. The asset continues to grow for your children while your estate only holds the fixed value of the note. For married couples who are concerned about maintaining their lifestyle while still reducing their tax exposure, the Spousal Lifetime Access Trust or SLAT has become the go-to solution in 2026. A SLAT is an irrevocable trust created by one spouse for the benefit of the other. This allows you to move $15 million out of your combined estate while still maintaining indirect access to the funds for your spouse's distributions. It provides a safety net that traditional gifting does not offer. However, as we navigate the complexities of modern law, you must be careful with the reciprocal trust doctrine, which prevents spouses from creating identical trusts for each other. In 2026, sophisticated advisors are drafting these trusts with material differences in terms and trustees to ensure they stand up to the highest level of scrutiny. The SLAT remains one of the most Effective ways to utilize the new $15 million exemption while keeping the family's financial flexibility intact. Another high-performance tool for the 2026 environment is the Grantor Retained Annuity Trust or GRAT. These are particularly powerful in a market where you expect specific assets to outperform the federal interest rates. When you place assets into a GRAT, you retain a right to receive an annuity payment for a set term of years, and at the end of that term, any remaining growth passes to your beneficiaries tax-free. In the current economic climate, many wealthy families are using zeroed-out GRATs, where the value of the gift to the heirs is calculated as zero for tax purposes, meaning you can move millions of dollars in appreciation without using a single dollar of your $15 million lifetime exemption. This is often called the heads I win, tails I don't lose strategy, because if the assets do not grow, you simply get them back, and if they explode in value, the gains go to your children free of federal tax. Liquidity is often the silent killer of great estates, and this is where the Irrevocable Life Insurance Trust or ILIT plays a vital role in 2026. If your wealth is tied up in illiquid assets like a private company or a massive real estate portfolio, your heirs might not have the cash to pay a $10 or $20 million tax bill within 9 months of your passing. An ILIT owns a life insurance policy on your life, and the death benefit is paid directly to the trust instead of your estate. Because the trust owns the policy, the proceeds are not subject to the 40% estate tax. This provides your family with a pool of tax-free cash that can be used to pay the heirs without having to sell off the family's crown jewels at a discount. In 2026, we are seeing more families use private split dollar insurance arrangements within these trusts to fund massive policies while staying within the annual gift tax exclusion limits. Valuation discounts through family limited partnerships and limited liability companies remain a core component of advanced planning this year. By placing your assets into a family entity and gifting minority interests to your heirs, you can often claim discounts for lack of marketability and lack of control. In 2026, up 30% discount on a $10 million gift effectively allows you to move over $14 million of value while only reporting a $10 million gift on your tax return. While the IRS has long scrutinized these discounts, they remain a valid and powerful tool when supported by a professional appraisal and a legitimate business purpose. This strategy is especially effective for families managing large tracts of land or concentrated stock positions, where a single owner does not have the power to force a liquidation. Philanthropy also offers a unique path to tax efficiency for charitable-led trusts and charitable